everybody. Thank you so much for joining us today for this Fortune 500 focused webinar. My name is Samantha Seguenza, and I am in client services here at the Retirement Group, and I'm going to be moderating this webinar. You'll see me throw very valuable links into the chat. One will guide you to our LinkedIn, where you can view an update of all of our upcoming webinars, as well as our past webinars. I'll also include a link to our education center, where you can view a full recording library of all of our past Fortune 500 focused recordings, as well as a link to book an appointment with an advisor after this presentation. Our speaker today is Tyson Mavar. He's going to be speaking to you about the decision to retire early, which is a monumental decision, of course. Tyson is going to offer some crucial guidance to help you navigate this pivotal life change. He'll cover financial ramifications and help you retire with a sense of purpose. Before I bring Tyson on, I have to remind you that although the Retirement Group has extensive knowledge of Fortune 500 company retirement plans, we are not affiliated or endorsed by any Fortune 500 company. The Retirement Group is a completely independent group of financial advisors, so please keep that in mind. And after Tyson's presentation, I'll be coming back on to ask him any of the questions you may have entered in the Q&A box throughout his presentation. Please feel free to enter those questions in the Q&A box. It's down at the bottom of your Zoom window, and he'll answer as many as possible. It's completely anonymous, and we love answering your questions, so please don't be shy. And without further ado, I'm going to introduce you to our speaker today, Tyson Mavar. Hey, Tyson.
Thank you, Sam. And thank you, everyone, for attending our webinar series today. My name is Tyson Mavar, one of the retirement specialists here at the Retirement Group. In today's webinar series, we're going to talk about the transition process. We've seen a lot of changes happen in the thought process of our clients and people that we've worked with as they approach retirement. Just in the last few years, we had many people working from home for several years, and we're starting to see a shift to having employees working back in the offices, for better or worse. We're going to talk about today the decision to retire, both from a financial perspective, as well as a psychological and emotional perspective, and things that we think are important considerations to have as you approach this very big decision, in some cases irrevocable decision, to retire from a company, especially a company if you've worked for the same company for a number of years. Those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization. We manage retirement assets primarily for Fortune 100 company employees. We do that through Charles Schwab as a custodian. We're an independent group. And as a fiduciary, the Retirement Group takes their job very seriously in helping people protect and grow their wealth in an effort to minimize the risk of running out of money in retirement as the primary objective of most of our clients. We have a lot of different complementary resources we encourage you strongly to take advantage of and utilize. Sam mentioned the LinkedIn page, great way to get information specific to your company plans, as well as generic retirement planning information. We have a cash flow analysis that is designed to help people identify the best time to retire, but also to identify things that you can do while you're still working to improve your probability of success in retirement. A lot of times that's on taxes. Many times it's in taking advantage of your benefits plans to not leave any money on the table. Please take advantage of as many of these complementary services as possible. There's no expectation that you'll do business with our company by taking advantage of these different exercises and analyses that we have available. All we ask is if you get some value from spending some time with us, maybe help us grow our business by recommending some of your coworkers also talk to us. So whenever we talk to somebody for the first time about their retirement plan, we go through this checklist of what we find to be important items on the list toward a comfortable retirement. And the very top of that list is identifying values and objectives of retirement, but also understanding comfort and emotions. This is important for a couple reasons. First, what we found is that it's very important to identify what is important about your retirement to you, and maybe you and your spouse or you and your family, so you can start to identify how you're going to meet those objectives with the money that you've saved, or your financial resources, and become financially independent. It's also critically important because we found that emotions drive a lot of our decision-making, oftentimes not in our long-term best interests, especially our long-term financial best interests. Some examples of this is clients that we see having far too much money in their company stock than we would recommend. Oftentimes as a result, in some cases, of not having very many investment options in the 401k and that company just being the one that they're most familiar with or comfortable with. We also see this in the decision of timing, when they're buying and selling investments, when they are becoming aggressive or conservative. And oftentimes our emotions drive us to a strategy that's opposite our best interest, where we buy when we feel good about the stock market, which is typically when stocks are expensive. And sometimes we fear the worst when things aren't going well and end up having to sell our stocks for less than we probably could have had we had patience and removed emotions from the decision-making process. So this is critical. Part of our value proposition to our clients is being a sounding board for their emotions, their ideas that come up throughout retirement, especially when the retirement timeframe comes. That's the most critical timing, because there's a lot of decisions that need to be made. And in some cases, these decisions need to be made under duress because there's surpluses happening, there's downsizing happening at the company, there's changes to the interest rates that affect your pension, and you have to make a decision very quickly. We'll talk a little bit about that today, but this is critical. I know I spent a lot of time about this, but identifying what the next step means to you and your family, what types of things you're going to do with your new schedule, but also identifying the emotions involved in decision making that often will lead us to poor long-term decision making, and then just try to make decisions more rationally and not rely on our emotions. We always want to minimize our risk, which can be defined in different ways. Volatility is one of the risks of what we think of as permanent loss of capital at the retirement group, what we want to avoid in a retirement plan. But volatility is not necessarily our pure definition of risk. Our purest definition of risk, the retirement group, is a probability of losing money or running out of money. And short-term fluctuations in an asset aren't necessarily bad. In some cases, in most cases, they are essential to investing and having a good investment experience, because as we all know, stocks fluctuate. And for most people don't have enough money to not invest in stocks as at least a portion of their retirement plan. So we have to understand our definition of risk and start to mitigate the different types of risks that come our way in a retirement plan. Ultimately, most people want to maximize their retirement income. So it's a big checklist item here. And we do that through a variety of ways, maximizing our benefits that we walk away from the company, understanding the eligibility requirements, understanding the healthcare costs and the benefits associated with what our company is offering. And taxes play a big role in this. These are where people make massive mistakes when it comes to their retirement plan, is not understanding all the tax rules and overpaying in taxes as a result. So here's where we come in, educate our folks on the intricacies of the tax law related to retirement accounts, and build an individualized plan so that you can avoid some of the big mistakes. And everybody's plan is a little different. So some rules are going to be relevant to you and others not, based on your cash flow need, the age when you retire, and a variety of other variables. And then lastly, we want to put together a philosophy, figure out what's important to you, maybe you and your family, and then produce a plan that allows you to meet those objectives, whether they are just having a consistent paycheck for the rest of your life. Maybe there's going to be more money needed early in retirement and less money down the road as you age, and maybe don't have as much energy to do things in retirement. Maybe it's the opposite. Maybe there is a concern for the extreme cost of long-term care later in retirement, and we want to develop a plan to ease that concern or take care of that if the need ever should arise in the future. This is why it's important for us to get to know our clients, and why we spend a lot of time with our clients understanding their objectives. So today we're going to talk about some key changes that we've seen recently in this post-pandemic era that we're all living in here. And then we're going to go into pension-related considerations and decisions that you'll have to make when you retire, inflation, the risks of inflation, and some ancillary both benefits and costs of inflation, 401k and some of the tax implications of moving money out of these plans, and other decisions that you'll have when you leave the company. and then ultimately some of the big mistakes we've seen and why many people use an investment team like the retirement group to help reduce the probability of failure in retirement, or even the probability of small mistakes that could result in very large changes and errors in a retirement plan. Now, everybody has different sources of funds. This is why we build a customized cash flow analysis for everybody. Again, this is a complimentary service, folks. Please take advantage of it if you haven't done so yet. It probably would only cost you about 30 minutes of your time to go through this. You do have to share some information with us about your situation, and we'll do our best to make this a good investment of your time by bringing some value and things that you can do now to improve your position to retire. We've got to get to know a little bit about your sources of funds. So typically, most people will have at least a 401k or some savings plan. If you work for a Fortune 100 company, pretty much everybody that we work with as clients of the retirement group has at least a 401k. Most of our clients have some type of pension as well, and every plan is different. The options of how you can take that plan differ depending on what company you work for, as well as your heritage with the company. I work with oil and gas, telecom, and pharmaceutical company employees primarily here in Texas. And although every pension plan is different, they all have many similarities that help us to be able to narrow down our focus in understanding one pension plan to be able to understand all pension plans, because they all have a lot of similarities. For instance, defined benefit plans typically will have a negative correlation with the lump sum and interest rates. When interest rates are rising, the lump sum is falling. And how does your company actually observe that relationship? It's an important thing to know as you approach retirement, as well as what are your benefit options. Not every company offers a lump sum. Many companies offer multiple annuity options, a variety of monthly lifetime paychecks that are worth considering and running numbers on to figure out the merits of each benefit option before you actually leave the company and have many other decisions to make. Real estate is an asset for most of our clients. Many of our clients have at least some equity in their home. Not all of our clients own their home. Some of our clients own multiple homes and investment property. We need to include this in the plan. And typically we're not including our client's primary residence as an asset to rely on in their cash flow analysis. However, the equity in that home ought to be considered for decision-making purposes, especially if you might consider moving in retirement. Many of our clients move to maybe a state that's more tax-friendly or has a lower cost of living, maybe closer to their kids or grandchildren after they no longer are stuck to the place they live based on their job. And this is also changing as a result of this return to work or return to the office push that a lot of companies are putting on their employees, making many people consider leaving their company or consider a different job potentially to allow them to meet their needs of staying at home or being close to family members. So we have to consider real estate and the equity you potentially have in your home as a portion of this retirement plan, and the ability to potentially leverage that equity throughout your retirement plan. And Social Security, last but not least, most people we work with have Social Security. There's a variety of different benefits that are important to understand. The workers benefit, the spousal benefit, and the survivor benefit all play into most of our clients' retirement plan. So not only on the decision of when to take Social Security, but the tax and distribution strategy around your options with Social Security, as Social Security is not fully taxable like withdrawals from your traditional IRA or your 401k are. Understanding all of the ins and outs of these different sources of income and sources of funds in retirement are critical to making good decisions on each of them. Now, we're going to go through what we've seen in the last few months, but certainly in the last few years as people started working from home as a result of the pandemic and are now starting to shift and working back in the office. Employers are leveraging what is being called the power of proximity, which is emphasizing the benefits of collaboration and spontaneous idea generation for having people working together in person. Now, we definitely have seen people be more comfortable with, we're recording this on Zoom. Even my parents, who never would have done a web meeting in the past, are now comfortable with and familiar with using web meeting software like Zoom and many others, WebEx, Teams, Google Meeting is another good one. to be able to work from home. Although many companies are starting to shift that narrative because they find benefits in having people come into the office potentially to have better collaboration and be more productive in some cases. Now, everybody's different. We've seen people very effective working from home, and then there's other people that are just not as productive from working at home. But across the board, we're seeing this in many, many companies. For instance, Apple is implementing a flexible work policy to get people to work in the office at least 3 days a week, but they're still allowing people to work from home at least a couple days of the week in many cases. Every company is looking at this differently. There's some companies that are having a very hard line. Everybody needs to be back to work by a certain date. Otherwise, you don't have a job. This is actually happening with one of the companies that I work with, AT&T, where not only are they making people go back to work in the office, but they're making people move to a different city and consolidating their employees into a number of hubs that they call them. Dallas and Atlanta are just a couple in AT&T, and people that they're actually being displaced. If they don't move to one of these big hubs, they're going to lose their job and not have the opportunity to work from home. I've also seen some of my clients voluntarily leave their company without severance package because they are just not interested in going back to work at the office at all anymore. They're not interested in the commute. They're not interested in, maybe getting dressed nicely and going to collaborate with people in person anymore. Maybe there's health concerns. There's all sorts of reasons, but this is what we're seeing be a big push for people entering into retirement either early or earlier than originally expected because of a disinterest in going back to work in the office. Now, this is going to be hard for a lot of people, but it's going to be required, and we're going to see less and less remote working. We've also seen, as a result of the pandemic, many companies selling off a lot of their corporate real estate and maybe renting back areas, but to reduce their corporate real estate exposure because they just don't need as much of it. But now we're seeing companies, like we've talked about, encouraging employees to come back to work, and we're seeing this have negative impacts on the morale at the company. And in some companies, we're seeing actually positive impacts based on people getting back, socializing in the office, getting back together. It's not for everybody though. And people that have gotten accustomed to this remote working are likely going to either have to, like in what I've seen with some of my clients, leave their company and just go get a part-time job. And we built a cash flow analysis that allows them to do that, or tried to at least, and be honest with the folks that we don't think can afford to do that, or at least tell them what we think they need to earn at the next job to maintain a sustainable retirement plan. That's our purpose and our proposition to our clients, and helping them figure out when they can afford to never work another day in their life. And if they're looking to potentially leave their company, how do you get to that point? And it may be some part-time work, maybe even some full-time work. Hopefully in some people's case with the ability to work remotely, if that's important to them. Now, this is changing a lot of retirement strategies like we've talked about. If you leave prior to 59 and a half, we'll talk about some ways in just a moment here that you can get penalty-free income from your retirement accounts, like your pension, like your 401k, like your traditional IRA. Assets that are pre-tax and are otherwise taxable if you withdraw the money prior to 59 and a half do have some exceptions to accessing that money. And in some cases, it's only as a supplement to some other form of income. For instance, a client that left last year started what's called a 72T income stream. This is an IRS-approved method of taking penalty-free withdrawals from your retirement account. In his case, it's an IRA. But in his case, he is also working. He's supplementing his 72T or retirement income that's penalty-free with a part-time job. And we set it up so that his plan is to work even past 59 and a half now, but he's going to have that 72T income coming at least until he's 59 and a half. And we had to restructure his plan based on him wanting to leave his company earlier than he originally had forecasted in our original plan. Plans changed a little bit. We found a very tax-efficient way that he can still have a good retirement plan and do the things that he wants to do and have enough income to do them. Now, the pension is For most of our clients, it plays a big role in this retirement income strategy. Whether you take a lump sum or an annuity on your pension, we want to make sure that first you're making a good decision, but then that we are using that strategically so you're not getting taxed too much on that plan. You're not making mistakes with that money, and that you're able to maximize its longevity in your retirement plan. This doesn't apply to everybody, but most defined benefit pension plans have a lump sum option, in my experience. And most of those lump sums have a negative correlation with interest rates. In other words, when interest rates go up, the lump sum drops. And we've definitely seen that in the last couple of years as interest rates have really gone up in an effort by our central bank, the Federal Reserve, to curb inflation that has been quite high in the last couple of years, 40-year highs in some cases. And it's a good relationship to remember. Every 1% increase of the rates, it's roughly a 10% drop in a defined benefit lump sum. This is also a function of your age, and the younger you are, the more severe that impact is. Typically for somebody in their early 50s, it's closer to a 15% drop in the lump sum for every 1% increase of these interest rates. And every company looks at this differently. Some companies will change these rates monthly, some quarterly, some annually. And the more frequent the change, the less you see your pension fluctuating. For instance, if it's changing monthly, you're not going to notice it as much because these interest rates don't change too much on a monthly basis. However, some companies change this annually, and the change can be pretty dramatic. Last year, one of our companies changed the rates on January 1st based on annual update. And many people were losing 35% of their pension on January 1st, at least the lump sum option, unless they left their company and took their pension out of the plan prior to the interest rate change happening. So this is critical to understand how your company observes this, which interest rates they're using, the timing of when they change these rates. And if you're considering a lump sum, something that you want to pay attention to, especially as you get close to retirement, to avoid losing a large sum of your retirement net worth, in this case, overnight for this company. And it might change your plan. It might change the timing of your retirement, or it might change, like I had several clients at the end of last year decide to go work another job part-time several years before they planned on leaving their company. And now they have a lower stress job, as well as in one of their cases, several $100,000 more in his retirement plan because he left the company before the end of the year, and it was in his pension plan. So in some cases, it actually can benefit you to leave earlier than you thought. In this instance, that it affects your pension lump sum. Definitely, first you need to understand that option is even appropriate for you. Lump sum's not appropriate for everybody, and then understand the timing issues and when might be the best time to take that pension. I'm going to zoom in here to the rates that affect most plans. These are the IRS segment rates, also called the present value segment rates. They're associated with corporate bond interest rates. You can see here we have May of this year going back to May of last year. And these three interest rates are looked at differently by every company. I'll give you an example. One company that I work with, Chevron, uses the third, fourth, and fifth month prior to the month that you are commencing your benefit. So not necessarily the month you retire, but the month that you decide to take your pension. They're going to use data from 3, 4, and 5 months prior to that month, and that's how they're going to calculate your lump sum. You can see May of last year, rates, they had been going up prior to May of last year, but they had gone up to 4.59. And then they went all the way up to, in October, 5.83, and then started coming back down again. So as a result of this, some people have actually seen their lump sums go up in the last few months because corporate bond interest rates have gone down. Full disclosure, these corporate bond interest rates don't affect every pension. Some pensions are still using the old Treasury interest rates. But as a result of the Pension Protection Act in 2006, many companies, and by the way, the Pension Protection Act protected the interests of the companies by allowing them to use higher interest rates, which produce lower lump sum payouts to employees. These interest rates affect most companies now, and these are the ones that we watch on a monthly basis because that's how often the IRS publishes them. But you need to know which months your company is using for your pension calculation to be able to make good decisions on not only when to retire, but when to take your pension. And the two might not coincide. We also have been paying a lot of attention to inflation, and a lot of our clients have listed this as one of their number of concerns in retirement. Inflation hit 40-year highs last summer. It was up to close to 9% annualized. It means the average good and service that we were buying in the United States was 9% higher last summer compared to the prior summer. Inflation has come down a bit. The most recent announcement is it's just over 4% annualized. The Federal Reserve's goal is 2% annualized, and they had done a decent job of that prior to a lot of the government spending and monetary stimulus that came with the COVID-19 pandemic. It appears that they are successful to at least some degree at getting these inflation rates to come down, in part based on jacking interest rates up to slow inflation down. But there has been, of course, detriments to higher interest rates as well. What we found, and this is a T. Rowe Price article, many fixed income investments do poorly in a climate of rising prices and rising inflation, because bonds have a negative correlation with interest rates. In other words, when interest rates go up, bond prices also go down, just like your pension lump sum goes down if you're on a defined benefit plan. And you probably saw this if you own any bonds, especially long-term bonds in your retirement portfolio last year. For a number of years, we had been recommending alternatives to bonds for our clients, things such as fixed annuities, fixed index annuities, money market, direct bonds. If you can hold them to maturity, it can reduce interest rate risk. And this also needs to be considered when building the investment allocation in your retirement plan, the risk of not only inflation, but the risk of rising interest rates and what that does to the value of your asset. Now, with regards to the 401k, there's some tax and rollover implications that we want to be aware of. So first, let's talk about the tax issues. When you withdraw money from a pre-tax account like a traditional IRA, 401k, or if you take your pension as a lump sum and roll that over into either of those accounts, an IRA or a 401k, when you pull money out, you're going to be taxed at the federal level and potentially the state level, depending on your state. You also may have an additional penalty tax of 10% if you take that money out prior to 59.5. There are some exceptions, though, and there's a number of them listed here. There's 9 different exceptions, and then we've added on a couple different very unique exceptions. If you have some highly appreciated company stock, for instance, in your 401k, net unrealized appreciation is a great tax strategy to reduce your overall taxes on those shares of stock. And we have many clients that are highly compensated employees as far as the IRS is concerned, where they actually can't roll over their entire 401k or pension, and they have to pay ordinary income taxes on a portion of their pension or 401k when they leave their company. And this other list of 9, I mentioned one of them earlier, 72T is a great one for folks that, especially folks that are even younger than age 55. The reason I say that is because there's a really good one for folks that are over age 55, or at least who are going to turn 55 later in the year that they leave their company. It's actually part of the same section of the tax code as 72T, but it allows for withdrawals on a penalty-free basis from your 401k, but it does not apply to IRA. So this is in some cases why you might want to consider leaving your 401k alone when you leave your company. If you're not yet 59.5, it might be the best place to get penalty-free income in your retirement plan if you need some prior to 59.5. So, everybody's situation is different with these. We need to understand more about your situation before we can recommend a plan, but there's a lot of great, I don't want to call them loopholes, but sections of the tax code that if you're not aware of them, that's on you. It's your fault for overpaying in taxes. So first you need to be educated on what you're allowed to do, and then understand what's likely the best route for you to take to not only minimize your taxes, but to maximize your retirement income, not just when you retire, but for the rest of your life, regardless how long that might be. Now, in most cases, you don't have to do anything right when you retire. There's exceptions to this. I have one company that forces their employees to make a decision on whether or not they want a lump sum within 90 days of their retirement date. Otherwise, they lose the option to take a lump sum. There's some companies that, this is actually most companies, will force you to take your pension as of age 65. So if you retire after 65, oftentimes you've got to take your pension right away. You can't defer it. Now, in most cases, it doesn't make sense to defer the election of the pension anyway, unless it has some type of growth associated with it. So many pensions will be indexed to a certain interest rate, like the treasury rate or corporate interest rate, or they will have a formula that allows that pension to continue accruing even after you left the company. So you've got to understand first what that growth rate is. If you defer the election of your pension, and let's call it 3%, you find out you retire at 58 years old and you run a projection for your pension at 65 and found out that it was growing by 3% a year during that 7-year period. Well, 3 years ago, that might not have been so bad, but now we have CDs, many cases today, paying north of 5% on something that's federally insured. 3% doesn't sound as attractive when you can earn maybe close to double that in a low risk environment. So these are decisions and considerations to have when deciding to take that pension. But remember that pension election in almost all cases is irrevocable. So you definitely want to do your due diligence when deciding to take that pension, not only which option to take, but when to take it, so that you're optimizing the growth rate on that money throughout your retirement plan. Now, when you roll over a pension lump sum or a 401k into a traditional IRA, there are not taxes on that transaction. There are some exceptions to that as well. We talked about a strategy, NUA. You might want to pay some taxes up front in an effort to have a substantial tax savings in the future. You might want to consider a Roth conversion where you're taking either after-tax or pre-tax money in your 401k and moving it to a Roth IRA. But moving pre-tax money to a Roth IRA would be considered a conversion that is taxable, may or may not make sense based on your tax bracket status. So there are some exceptions to that, but in most cases, this is a non-taxable event. I hear this all the time, a misconception that if I take the lump sum, I'll be taxed on it right away, be in a higher tax bracket. Not the case as long as you roll it over correctly. Now, something else we see a lot of people making mistakes on, we talked about the taxes, we talked about investments and making emotional decisions, choosing an advisor, and in some cases not choosing an advisor. Seen people decide that they think they could do this on their own, and they call us several years after they retire, they made some mistakes, and just throw in the towel and decide we need some help with this. The stakes are very high when it comes to your retirement plan, and in most cases there are no do-overs. One small mistake could mean tens of thousands of dollars less in your plan, and you might not be able to afford that kind of a mistake. And I've seen some people also make a mistake and never find out they made the mistake. And I have to unfortunately tell them you shouldn't be doing this. Of course, it's better to correct an error than to continue doing it. But not everybody needs help with a financial advisor. I think it's worth at least meeting with one and probably a couple different groups to see, what kind of value is brought to the table. And some of the value propositions that our clients and people that we've met with over the years have told us are important to them are understanding their benefits plans. And we've talked about the intricacies of different pension options on today's webinar series. We don't know all companies' benefit plans, but we know quite a few in the 30 plus years that we've been doing this for retirees. So it might not be a bad idea to work with a specialist. Having an investment team. There are some financial consulting offices where the advisor, somebody like myself, who is a representative who helps you with your plan, helps you understand the rules, is also making investment decisions and is doing research every day, placing trades every day. We found that it's better to separate those two. We have a team that focuses more on the analysts, and we have advisors, myself, the representatives that have the relationship with the clients. That way we can do what we're best at and focus on what we're better at. And then, you may have different concerns than the next person. You may be more interested in estate planning than somebody who's purely interested in just making their money last as long as possible, and they don't care about leaving money to their kids or grandkids or a cause that's important to them. you may have a different and more complex tax situation than somebody else. Everybody's going to be a little bit different, and this is where you want to understand what value you're getting from your advisory firm, as well as what the cost is for the value that you're getting. And now everybody's different in terms of the investments that are appropriate for them, their risk tolerance, their objectives, their cash flow need. You need to have, or at least our opinion is, you need to have a customized plan that is unique to you. And the cost of that is going to depend, but most of our clients are paying less than 1% per year of assets under management. That's how much they pay us for the service. They get billed quarterly. It's pay as you go. You don't pay an upfront fee to become a client. You're not committed to any period of time, which we think is also very important. And we also think that you might want to consider developing a relationship prior to retirement with an advisory firm, whether or not it's ours, so you can test their services out, and maybe with a smaller amount of money to see if it's a good fit prior to having a much larger sum of money that you need to make decisions on. So let us know if you're interested in having us, A, run the retirement plan, again, a complimentary service, B, doing a review of your 401k and your investment allocation. And if you're interested, we can talk to you about how to become a client, if that's something you're interested in exploring, and what the cost of that would be if you decide to move forward with us. Unfortunately, statistically, 74% of Americans over the age of 50 don't have a written plan for their retirement. This is just, I say this on every webinar series. It's crazy to me that this is the case, just because I know how important it is to have this plan, because that's when mistakes are made, when there is no plan. Get this done, folks. We'll do it for you for free. Just let us know. No obligation to do any business with us. We just ask that you help us grow our business if you found value in that conversation by recommending us to a couple of your coworkers. If you'd like to get in touch with us, whether it's just some specific questions, you want to have us run that cash flow analysis, or if you'd like to run any of the other number of analyses we have, the NUA analysis, 401k, asset allocation analysis, you can email us at info@theretirementgroup.com, call us at the home office at 800-900-5867. These QR codes here are a great way to get in touch with us. One is to schedule a meeting. If you take a picture with your smartphone of the QR code on the left, the one on the right is that LinkedIn page QR code, where we will publish this webinar as well as many other webinars covering lots of different topics. Great way to keep up to speed on tax rule changes, changes to the economy and investments, and changes specific to your company benefits plans. So with that, we're going to not wrap it up just yet, because we may have some questions. So Sam, I'm going to pass it back to you in case any questions came up on this call or this week.
Actually, we had a few good questions, Tyson. The first one, how might early retirement affect my healthcare coverage and costs?
Yeah, great question. That is going to depend on which company you work for. And so you may not even have coverage through your company. That'd be the first thing to identify. If not, or whether or not you do, you might want to consider or shop around different plans, like the state exchanges we found as popular for some retirees that aren't yet 65, and as a result aren't qualified for Medicare just yet. You may want to look at your spouse's plan. I have clients where he was on his plan and she was on her plan when they were both working. He had retiree healthcare available from his company after he left, but in shopping around his wife's plan, found out that it was cheaper for him to jump on her plan as a dependent or as a spouse, rather than going on to his company plan. Now, his company plan allowed him to come back on the plan after she retires, which I've also seen not be the case for some companies. So you need to do some homework on this, because you don't want to lose a benefit that might otherwise be pretty valuable to you over time. But I would say first call a benefit administrator. Call us if you work for one of the companies that we understand the benefits on, and we'll guide you through what we think is a good step-by-step process to determining what your best route is for healthcare insurance after you leave your company.
Thank you. 2, if I leave before 75 points, is there a way to bridge my years of service?
That's also very specific to your company. It's probably from one of our AT&T clients, where you have to have 75 points of years plus service in a very specific way. They don't even offer health insurance to the managers. They'd still offer it to their union employees. But that's pretty common for companies to have some benefit eligibility criteria like age plus service, 75 points, 80 points, 55 and 10, some criteria that you want to make sure you understand and then probably want to try to meet especially if you're close. So I would ask that person to call us so we can understand which company you work for first.
Great. Last one, how can I assess and manage the potential tax implications of retiring early, especially in relation to my retirement savings and investment income?
Yeah, that's a great question. I'm guessing that person is not yet 59 and a half, so you may qualify for one of these special exceptions, an exemption on the free 59 and a half withdrawal penalty. You've got to run a cash flow analysis. That's as simple as that. And we could do that for you on a complimentary basis. And then first understand what any penalties might be, and then try to put together a tax efficient withdrawal strategy, which might include some part-time work to supplement withdrawals from a retirement plan. And we're seeing this very common for our clients. They're leaving their job that in some cases is forcing them to work in person to go find a job that will work remotely. And in some cases only have to work a couple days a week or, maybe 20 hours a week, something like that. So I'd say call us and ask for the cash flow analysis, and we're happy to put it together for you.
That was all the questions we had, Tyson.
All right, great. Well, listen, thanks, Sam, for the help today. And thank you folks for joining us today. Everybody have a good, safe rest of your week. And we hope to talk to you all very soon.
Thank you.